Apple just posted its best March quarter in company history, $111.2 billion in revenue, up 17% year over year, with iPhone delivering a record $57 billion. The stock jumped 5% on earnings day, closing in on an all-time high. And then the CEO said something the bulls quietly skipped past. Tim Cook told analysts that the RAM memory crisis is not going away anytime soon. Apple sources its high bandwidth memory from a market that is already supply constrained across every major buyer. The same hyperscalers spending hundreds of billions on AI infrastructure are competing for the same components Apple needs to build the iPhone 17 and next-generation Macs. When Apple guided Q3 revenue growth of 14% to 17%, that guidance baked in margin assumptions that depend on memory costs not deteriorating further. That is the unresolved variable Wall Street is now pricing 3 different ways. Morgan Stanley raised its price target to $330, calling Q2 a clean report with a remarkable margin outlook. Wells Fargo moved to $310, noting that gross margin guidance came in 50 basis points above street estimates. Barclays kept its underweight and a target of $253, citing the absence of a clear AI monetization strategy and second-half estimate risk tied to memory inflation. The same $111 billion quarter, 3 conclusions, because the answer depends on a component market that no one controls. Apple also authorized a fresh $100 billion buyback and raised its dividend 4%. At a $4.1 trillion market cap and a PE of 36 times, the bull case is already in the price. The question Barclays is asking is whether the second half delivers the margin durability that justifies it. The services segment hit an all-time high of $31 billion, and Greater China came in at $20.5 billion, both in the right direction. But the memory overhang is structural, not cyclical. Apple's own supply chain team has flagged it, and the CEO confirmed it publicly. That is the friction buried inside an otherwise clean beat.
While Apple was delivering its earnings, the broader market was processing a number that reframes everything else, $725 billion. That is the combined AI capital expenditure planned by Meta, Alphabet, Amazon, and Microsoft for 2026 alone, revised upward from $670 billion just months ago. The breakdown reveals the scale. Amazon committed $44.2 billion in a single quarter, with AWS growing at its fastest pace in 15 quarters. Alphabet spent $35.67 billion in Q1 CapEx, more than doubling year over year, while its Google Cloud backlog nearly doubled to over $460 billion. Microsoft added $30.88 billion in fiscal Q3, up 84% year over year, with its AI business crossing a $37 billion annual revenue run rate. Meta raised its full-year CapEx ceiling to $145 billion, and investors punished the stock 9% in a single session, not because the spending is irrational, but because the return timeline is uncertain. Every dollar of that $725 billion lands somewhere in the semiconductor supply chain. NVIDIA's data center revenue hit $62.31 billion in Q4, up 75% year over year, with networking growing 263%. The hyperscaler spending is functioning as a demand floor for chip stocks, memory, power infrastructure, and interconnect hardware. That is why the S&P 500 and NASDAQ closed April at record highs, despite an active war in the Middle East and the worst consumer sentiment reading in 74 years of University of Michigan survey history. But the records arrived alongside the most divided Federal Reserve in a generation. At Jerome Powell's final FOMC meeting before his May 15th departure, 4 voting members dissented, a level not seen in 34 years. Stephen Murin pushed for a rate cut. Beth Hammack, Neil Kashkari, and Lori Logan opposed including any easing bias in the statement at all, citing the oil price shock from the Iran war as a persistent inflation risk. The outcome? Rates held at 3.50% to 3.75%, and the probability of a June cut collapsed to effectively zero. The S&P 500 Shiller-Cape ratio is now near 41, above 99% of readings going back to 1871, and the highest since 2000. The market just hit a record without the rate cut fuel that underpinned its prior expansion. That is a structural change, not a footnote.
The thread connecting Apple's memory problem to the Fed's paralysis runs through the Strait of Hormuz. Brent crude briefly topped $125 per barrel as Iran's weaponization of the strait turned from a theoretical risk into a live cost shock. WTI has risen above $105. The Exxon CEO told CNBC the market hasn't seen the full impact yet. Upstream supply disruptions typically take 60 to 90 days to flow through to refined product prices and corporate input costs. That delay matters enormously. The Fed is watching an oil shock whose full inflationary weight has not yet registered in the CPI. 3 of 4 dissenting FOMC members cited this explicitly, arguing that cutting rates, or even signaling a willingness to cut, while a supply shock is still propagating, would be a policy error. The historical parallel they are drawing is 1970s stagflation, an oil shock absorbed too quickly by an accommodated Fed that then had to reverse course into a recession. Markets are telling a different story. The S&P 500 rose through the Iran shock, just as it rose through the first months of Russia's invasion of Ukraine. Analysts at the Globe and Mail noted that equity markets have historically bottomed within the first 10% of a conflict's duration, long before outcomes are clear. The S&P 500 rose 50% through World War II. The weight of evidence points toward the market absorbing the oil shock without a recession, but only if two conditions hold. First, the Strait of Hormuz disruption does not escalate into a full naval blockade, which would push crude toward 150 and force central banks globally to choose between inflation and growth. Second, AI CapEx monetization, the $725 billion question, begins producing enterprise revenue that justifies the spending curve before free cash flow constraints force a pullback. Amazon's trailing free cash flow already fell 95% to $1.2 billion as CapEx surged. If the revenue catch-up stalls, the AI infrastructure build-out to slow precisely when memory markets and energy costs are at their most expensive. The verification point is the May ISM Services PMI, due next week, combined with U.S.-Iran peace talk progress out of Islamabad. If services inflation holds above 5.5 and talks remain stalled, the Fed's hawkish dissent bloc will have the data to block any June easing signal from Kevin Warsh's incoming tenure. If oil pulls back to 95 and talks resume, the calculation reverses, and the rate cut trade that has been priced out of June could re-enter July. The final variable is one number that does not yet exist, Apple's Q3 gross margin, reported in late July. If memory costs compress margins below guidance, the $330 price target disappears. If they hold, the $253 target looks like the one that missed the story.